For more on the IPO market, let's bring in Matt Rowe. He is the Chief Strategy Officer at Context Asset Management. Matt, good to have you with us.
Thank you for having me, Michelle.
So Matt, as we discussed there, so far 2016 has been the slowest year for IPOs since 2009. According to Renaissance Capital, filings have been down by 54%. What's going on?
Well, as you referenced in the intro, there's been a lot of activity from private equity space. There's also a motivation for companies to stay private. A lot of companies are seeking M&A deals and are being acquired on their way to the IPO market. Examples like Petco, which was slated for an IPO, diverted to a private transaction on the way to the market. Lastly, I would say that valuations are relatively competitive between the two. So when you add it all together, there's an incentive for companies to weigh their options on the way to the IPO market.
The big dream used to be to exit with a public listing, but now you're saying valuations are relatively competitive. Explain that.
Yeah, so the bid from the private equity companies for pre-IPO deals is high. One of the incentives is that private equity is structured such that they get paid to put money to work, to make investments. There's a lot of money on the sidelines right now in private equity space, and they're looking for ways to use it. I believe the rough number was north of $800 billion last time I checked.
So if private equity firms are increasingly selling their holdings to strategic investors, what does that indicate about the amount of private capital out there?
Yeah, there's a lot of it out there, and the pool has been growing.
Well, how come? What's driving that?
Well, one of them is that with the interest rates as low as they are, there's a big bid for growth, matching forward liabilities with investments to manage those forward liabilities. People are making private investments and with a longer time horizon.
Okay, so far the IPOs that have gone through, what are the returns that they're bringing?
So the small deals have done pretty well. The larger market. The larger deals have done not so well, meaning that they've underperformed the S&P and their peers. So it's not been overwhelming. There hasn't been a big incentive to dive in on IPOs for quick, easy money, with the exception of tech.
Well, you mentioned tech. So far, just 2 IPOs have priced above their range this year. Big tech companies, Twilio closing up nearly 92% on its first day of trading in Line, which closed up 27% from its IPO price. So what do you make of that?
Well, there's a couple of things for it. As you mentioned as well, there's been a lot of M&A activity in technology, so the premium for gross revenue in technology has been relatively high. And technology companies see this. They see that the public IPO market is undervaluing and underbidding for their equity, so they're incentivized to wait.
Well, let's talk about the sectors, because we've seen the most IPOs in the healthcare sector over the past 12 months, 51%. Why? Why healthcare?
Well, I think healthcare is a tough business. It's very broad. It's a very large segment of the market, but it doesn't have the growth prospects and the potential expansion and explosive growth that you see in tech and in other sectors in the market. So the private equity firms looking for year-over-year growth of gross revenue and profitability, they don't see exactly what they're looking for that they see in things like tech and other sectors.
So you don't expect the healthcare trend to continue in terms of increased IPOs?
I think that there's a lot of interest in the healthcare companies to raise equity capital and to raise debt capital as well. But again, it's not relatively as interesting to the private markets as some of the other sectors. So I think we're going to continue to see a disproportionately high level of activity and IPOs from healthcare.
Does this slow IPO market signal something about the health of the economy at large? Can we extrapolate anything from this?
No, I think it's hard to jump to any big conclusions based on that. I think what we can say is that there's a shift in the way that investors are behaving. One of the other incentives for companies to not go public and to do a private transaction is that a lot of the end investors like the fact that they don't have to be called to task on what their profitability on their portfolios are on an hour-over-hour and a day-over-day basis. It really changes the nature of their relationship.
Right, they don't have to answer to shareholders, deal with activist investors, and
Exactly.
Obviously there's less regulation. And speaking of less regulation, this has been something that perhaps has been relevant to the Uber IPO, because people have been wondering what's happening with Uber, but it does look like they may be setting up to list, right?
Yes, yeah. So just as recently as yesterday, Uber sold their Chinese operations to Didi, and in what appeared to be a relatively big capitulation, and is also read as a big step towards them hitting the IPO market. The CEO of Uber himself has said that he wants to wait as long as possible. I mean, I think the way that we can read into that is that he believes that the multiple and the price of his stock offering in the IPO market is going to be based on revenue, not based on profitability. One thing in relation to Uber that I think is important to notice is this whole story of a slow IPO market could change very quickly if we see the likes of Uber, Airbnb, and Snapchat and a couple of others, that all of a sudden the story may change to this being a massively outperforming.
Do you expect to see those companies move towards that in the second half of the year?
I would expect to see at least one of those companies move, with the obvious name being Uber. I think most of the market now reads through that they're preparing to go public. A lot of other companies are waiting to see what the pricing is in the market for that. I think that's another reason why activity has been relatively low, is because there's this big bellwether deal hanging over the market, and people want to see what the pricing is.
They want to see what that would indicate about other such companies in the sharing economy, like Airbnb, for example.
Correct.
What are the projections for its IPO?
So if you add up Airbnb, Uber, and Snapchat together, they're over 100 billion in current estimated market value. So
100 billion.
100 billion, yeah. I believe the last estimate
Even
I
though
saw,
Snapchat hasn't really monetized.
Correct.
Okay.
Yeah. And I think it's also fair to cite the obvious fact that Uber itself is losing money. So we're talking about pricing revenue, we're not talking about pricing profitability.
So what is your projection for the second half of the year?
I think that the story at the end of the year will be that we're eclipsing or nearing the 2014 decade highs of the IPO market, because just with Uber at 68 billion, you add that onto the 11, now all of a sudden we're talking about 79, 80 billion in IPO assets raised this year, which is a stark contrast to the 11 that we're looking at right now.
All right, so from the slowest IPO market in about 7 years to perhaps the biggest if the year closes out the way you're projecting.
Yeah, the biggest in aggregate, as well as the biggest public U.S. deal, as you referenced in the beginning.
We'll hold you to that. We'll see how that turns out. Thanks so much, Matt Rowe, Chief Strategy Officer at Context Asset Management.